Hey everyone, welcome back to the channel. It's Demetrius, and in today's video, what I want to walk us through is just one of those buzzwords that you hear a lot within the infinite banking space or within the whole life insurance space, overfunded whole life, high cash value whole life, however you want to see that. And so ultimately, the word that I'm referring to is internal rate of return, or IRR for short. And so when people think about rate of return, just in a general sense, normally we're thinking about what does my money do this year? What did my money do this past year? Right? We're talking about, did it go up 5%? Was it down 10%? Things of that nature. And I think in many ways, we're pretty much conditioned to think of it in that way, which again, I don't think there's anything inherently wrong with that by any stretch of the imagination. But when it comes to life insurance, especially policies designed for, high cash value, the internal rate of return, it does tell a much more complete story, especially when you're honing in and specifying on just what that cash value in and of itself is doing. But I will say, IRR in and of itself is not necessarily the whole story, but it does help to kind of round out the story in terms of the growth of your cash value. I hope that makes sense. And so it does sound like a little bit of a technical word, I think, at times, and it can kind of go over people's head, or they equate that to just general ROR, and that's not necessarily the case. But I will say, once you fully understand it, you'll realize it's one of the most honest and straightforward ways to understand what your money is doing over time, especially in a whole life insurance policy. Now, before we talk about internal rate of return, or IRR, I want to first start us off with something that's probably a little bit more familiar with most of the people that may be watching this video, which is just ROR, or rate of return, right? And so I want to just make the distinction that ROR, again, is not the exact same thing as internal rate of return. And again, you'll see the difference as this video goes throughout. So stick around all the way to the end, and I hope that you have the clarity that you're looking for. Now, with a life insurance ledger, when it comes to ROR, year over year return, what they call that is net growth percentage, specifically within the life insurance illustration that we'll be looking at today. And so what net growth percentage tells us is how much your cash value grew by this year. Okay, how much it grew by this year, accounting for your contribution. In other words, it answers this question: how much more do I have this year than I had last year after putting in more premium? How much do I have more this year than I had last year after making my premium contribution? And so the formula for this is actually pretty simple, okay? The formula is cash value minus premium paid divided by prior year's cash value, right? So let's take a look at year 10 of an illustration right now. All right, so we have an illustration on the screen here. We're seeing $100,000 per year in premium, and just know that whatever numbers that I may show on these illustrations, on these videos, just know that life insurance premiums tend to be pretty linear, especially when all other factors are the same, right? And so in this particular case, we're looking at a 40-year-old male, Carter Cashwell, at a preferred non-tobacco rate at this particular carrier. So anyways, back to the illustration here. So by that 10th year, as an example, $1 million has gone into the policy in terms of contributions over time. At that point, we're looking at $1.2 million of cash value. And so when you're looking at net growth percentage, what we have to do is, the math is pretty simple, frankly. We're taking your $155,103, which is what they call the change in total cash value, and they're taking this number minus this number. So this year's cash value minus last year's cash value. That's where they get this 155, right? So we take this 155 minus $100,000 here, and that gets us $55,103. This is the change in cash value less or minus premium outlay, $55,103. So then all we need to do is take this figure here, $55,103, and divide it by $1,047,582. What does that get us? That gets us the 5.26% that you're seeing right here. And perhaps you may want to pause this video, check my math, make sure I'm doing it right, all that sort of stuff, because I want to just highlight the fact that you being able to do this is something that's as simple as you being able to pull out the calculator that's on your phone right now, and you can always illustrate this. So even if you don't have a net growth percentage column within an illustration that you've been given, or with an illustration at a particular carrier, because not every carrier shows this on their illustrations, you can do that sort of calculation yourself if it matters to you. Okay, now what I want to do is just have us zoom out just a little bit. Okay, and so now I want to talk about internal rate of return specifically, because like I said, there is a difference between IRR and rate of return, or the net growth percentage. And so the question that IRR is asking is, if I put money, right? If I put this money in over time, what is the steady rate of return I would need to earn every single year to end up with a future cash value figure that I'm seeing on the ledger? Okay. And so it's like averaging out your performance across the entire journey, starting from day one, as opposed to looking at a couple year or just like a 1 year time horizon, right? And so if I go back to year 10 of the same policy, you're going to notice that the IRR is 3.33%, which is lower than that 5.26%. Now let's go and take a look at what I'm saying. All right, so we're back at the same illustration that we were looking at before. The only difference is we're now looking at the internal rate of return reports. And so if you scroll down, we were looking at year 10 before. And so now we're going to look at year 10 again. So we still have the same premium outlay. We got the same total cash value, but the only difference is we're seeing that there's a 3.33% internal rate of return on total cash value. And the reason that this is the case is because internal rate of return includes all the earlier years when the policy was like a capitalizing, and you're taking care of those early costs for a permanent product like whole life insurance. And so what it really shows us is a true average over time. Okay. And that's the reason that as you go through this illustration, you're going to find that it goes to 3.33 to 3.61 to 3.84 to 4.03 and so on and so forth. And so when you hear people like me or you hear other people online that talk about this stuff and are true experts at it, what you're going to find is that we're saying words like, averaging 3.5% to 4%, maybe 4.5%, maybe 5%, something in that neighborhood is normally what we're talking about. And usually when we say stuff like that, we're referring to the long-term internal rate of return, because we have to keep in mind that if we're looking at something like internal rate of return, it even overcomes the negative years that we started off with at the very beginning. So the question then here is, well, why is there a quote unquote negative rate of return in the first 4 years? Well, let's take a look at it. If I put in $100,000 and I don't have access to the full $100,000 yet because the policy is capitalizing, well, I can't have a positive rate of return yet, especially on the IRR of the cash value, right? Same thing for the following year. I put in 200,000 in total, I got 173. 300,000 in total, I got 274. Now we're getting closer, 400,000 in total. Now I got 385. Finally, fifth year, 500,000 put in, I got 504. And the thing that we have to account for is that when I look at a year 10, or I look at a year 15, right, and it says 4.31% or 4.7% or whatever that may be, that's the equivalent of you earning that level of rate of return every single year without a down year. That's your steady rate of return that you would have needed to earn given your contributions to end up at that figure there. So let's take a look at some math, because although you can't use a normal calculator, generally speaking, to find that figure, what we can use is a rate calculator. So a calculator that specifically is solving for the rate of return that you need, given some other variables that we put into it. So without further ado, let's take a look at it. So what you're seeing here on the screen is a rate calculator. So I'm just starting off with a present value of $0, okay? And then what I can't change is this 4.31 number, because that's the thing that we're actually solving for. And I'm just using 15 years as a time horizon just to give you an idea. I can do the exact same thing with any of the years that you see there. And we're showing $100,000 per year for each and every one of those 15 years. And at the end of the day, what we end up having is $2,138,176 at the end of the 15 years. And so when you do that, since it's solving for interest rate, you're now getting 4.31%, which is the exact same number that we saw in the internal rate of return column on the illustration in and of itself. And just to confirm, this is exactly what we see here in this illustration. And so I hope that gives you a little bit of clarity about the difference between rate of return and internal rate of return. Completely two different calculations. And not only are they two different calculations, you also have to realize that they're not necessarily competing for one another either. Net growth percentage shows you, again, what's happening right now, what's happening this year, whereas internal rate of return shows you what's happened since the very beginning. So if I had to give a running analogy, I used to run track in college. I didn't do long distance, but close enough. If you're running a marathon, right, and you're taking a look at your current pace in a marathon versus your average pace over just 1 mile, both do tell you something meaningful. Both do tell you something useful. But the only difference is that they just give you the full picture. So it's not necessarily that they're competing with one another. It just tells you a more foolish story. Hope that makes sense. And here's a part that I think a lot of people miss as well. Internal rate of return is not necessarily a scoreboard, right? It's not about beating the market. It's not about comparing your policy to someone else's, because your internal rate of return may be 4.5% at whatever point in the policy that you're at, while someone else's may be at 3.25%. And that doesn't make your policy better by any stretch of the imagination, because there's a lot of factors that go into life insurance illustrations and how they end up panning out and things of that nature. So everything from the company and the carrier that you're working with to just different people and their different ages and different health profiles, different contribution timelines, different goals, right? Some people want earlier liquidity. Other people care about long-term legacy. And some people care about access and control more than they care about maximizing the return. So yes, internal rate of return, it is useful. Okay. It's a very honest measure, but it's just one piece of the bigger picture. And if you get nothing away from this video, I want you to know that it shouldn't be something that we're honing into most specifically to measure against other policies or measure against, other investments, quote unquote, right? As we know, life insurance is not an investment anyway. And so with all that said, if you'd like help understanding what internal rate of return could look like in your situation, or how I would go about structuring a policy for your specific goals, go ahead and just click the link in the description or the pinned comment below to go ahead and schedule a time with me directly. I'll walk you through the numbers step by step and help you make sense of the numbers as well without necessarily getting lost in them. So thanks for watching. I'll see you in the next one.